Well, I guess not. So welcome everybody. Managerial accounting. It's chapter 8. We're kicking some booty, going right through this class. How's it gone so far? Decent? It's not as hard as you feared, was it? No. So we are going to talk today about master budgeting. Now, for those of you who are in class, it's good to have you and online. And then I also record these to YouTube. And it's amazing how many people need help in accounting. So I think I have almost 10,000 subscribers right now. So I hope you guys can benefit from it too. So we are going to talk about budgeting, master budgeting, and how the process unfolds in creating budgets. So a budget is basically a detailed plan for acquiring and using financial resources, and there are times other resources for a specific time period. Usually it covers a fiscal year. Some companies use a perpetual budget where it's constantly rolling forward. But oftentimes I see most of them create one for a fiscal time period. So oftentimes it covers a 1 year, and also in that 1 year, you've got smaller periods in there, quarter cycles. So they can also break it down into quarter increments. Now that continuous budget is just how it sounds. It continually rolls 1 month forward 1 month as the current month ends. Why are there budgets? For planning purposes and for controlling spending. Planning involves developing objectives and preparing various budgets to achieve those objectives. Control involves steps taken by management to increase the likelihood that the objectives set down while planning get fulfilled, and that all parts of the organization are working together towards that goal. So there's all kinds of ways you've got to start by just figuring out what the goals and objectives are. And you do that by thinking and planning for the future, determining the allocation of your resources, potential problems, how you can communicate these and coordinate the activities. Okay, all of this is, and it's a lot to come together and put out a budget. Ultimately, the goal is to improve operations. And as a result of those budgets, employees can be rewarded if they somehow fulfill or have a piece in fulfilling the budgets created. Okay. So some of it has to start with the top, the management, going down to the individual departments. Self-imposed budgeting is prepared with the cooperation of all levels. If you don't get the cooperation of all people in on it, it's not going to be as effective as it being told to you, this is what needs to happen. So when managers throughout the organization work together to prepare a budget, they often work to establish challenging targets that are also highly achievable. These goals are going to build a lower level manager's confidence and commitment to the budget if everyone has a piece in it. Okay. Advantages of these self-imposed budgets. It gives everyone a voice, basically. And if the people who are really involved in doing the production and making the money get involved, it's probably going to be a little more precise than someone saying, hey, this is what we're going to do this year. It becomes more motivating when people have a voice in what they want to plan on for the future. Ultimately, it's all about taking ownership of the budget. So if individuals get to have a say in it, then they have a voice, they take ownership, and they're more apt to be able to understand why they did exceed or deviate from the budgeted desires. Okay, so here's the deal. This is the overview of a budget. You need a sales budget. Then you need a production budget. The production budget has various budgets involved in it, the direct materials, the direct labor, and manufacturing overhead. Then you need a cash budget. When's cash going to be coming in? As a result of all these budgets, you ultimately can come up with a budgeted income statement for the year and by months, and a budgeted balance sheet. So to see the big picture, 10 schedules in the master budget are designed to answer the 10 questions shown on the next screen. How much sales revenue are we going to have? How much cash are we going to collect? How much raw materials will we need to purchase? How much manufacturing cost will we incur? How much cash will we pay to our suppliers and our laborers? And how much cash will we pay for manufacturing overhead resources? What's the total cost that will be transferred from finished goods to cost of goods sold? How much selling and admin will we incur, and how much cash do we need to pay? How much money will we borrow from, or how much will we repay to lenders? How much operating income will we earn? And what will our balance sheet look like at the end of the budget period? Lots of questions that will be answered in those 10 budgets. So this master budget we're looking at is really based on a lot of estimates and guesses. So the sales budget requires 3 estimates. What are the budgeted unit sales? What is the budgeted selling price per unit? And what percentage of accounts receivable will be collected in the current period and in future periods? So when Microsoft Excel is used to create a budget, these types of assumptions can be depicted in a budget assumptions tab, thereby enabling Excel-based budgets to answer what-if questions. So now we're going to look at preparing a sales budget. Royal Company is preparing budgets for the quarter ending June 30th. Budgeted sales for the next 5 months are April, 20,000 units, May, 50,000 units, June, 30,000 units, July, 25,000 units, and August, 15,000 units. The selling price is going to be $10 per unit. So if we take and spread this in an Excel sheet, and we take our budgeted sales in units with the selling price and the total budgeted sales, this shows us for the quarter, the budgeted sales for the quarter ending June 30th. April, May, and June. So we're just combining it all for a quarter period. Now, we have to start with the sales, and then we want to look at our cash budget. All sales in this assumption are on account. Royals collection pattern is 70% collected in the month of sale and 30% collected in the month following the sale. In April, the March 31st accounts receivable balance of 30,000 they're planning on it to be collected in full in April. So you see here, the March, what was left over, they plan on all of it being collected in April. And then April sales, they figure 70% of the 200,000 will be collected in April. The remainder will be collected in May. Then for May sales, 70% gets collected in May, 30% in June. So what they're doing is just showing how they're doing a cash budget, showing when money will be available. So guys, what will be the total cash collected for the quarter? I'm going to give you this slide. Actually, I should probably give you this slide. Okay. For the quarter, they told us about April, but we need to now take the 70% of June, the 300,000 here. So what's going to be the total collected? The 940. Because we've got the cash collected here, May, this amount, the 30% gets collected in June, and 70% of our sales in June are going to be also collected in June, right? 50. So it's 940 here. As you see, June sales, 70% of that 300,000 is going to be collected in June. Does that make sense how they're doing it? It's pretty elementary in a way, because we know from financial accounting, it's not this clean cut. You're going to have allowance for uncollectibles. We're just keeping it simple. Let's look at exercise 8.1. Silver Company makes a product that is very popular as a Mother's Day gift. Peak sales occur in May of each year, as shown in the company's sales budget for the second quarter given below. From past experience, the company has learned that 20% of a month's sales are collected in the month of sale. Another 70% are collected in the month following the sale, and the remaining 10% are collected in the second month following sale. Bad debts are negligible and can be ignored. February sales totaled 230,000 and March sales totaled 260,000. Using Schedule 1 as your guide, prepare a schedule of expected cash collections from sales by month and in total for the second quarter. So, and then what's our balance? So we see here the budgeted sales, add desired units of ending inventory, which gives us our total needs. Then units of beginning finished goods inventory to then show what we need to produce. Okay. Does that make sense, guys? Now we're going to prepare a production budget. So management at Royal Company wants ending inventory to be equal to 20% of the following month's budgeted sales in units. So they're letting us know on March 31st, 4,000 units were on hand. Let's prepare the production budget. So we see the budgeted sales. They know they want the desired ending inventory to be 20% of the next period's sales. And they already gave us what the beginning inventory was, okay? Which is 20% of April sales. So if you see, if we're planning on selling 20,000 and we want to end up with 10,000, 20% of May's, we need to have 30,000 here. Since we're bringing into the month 4,000, that means we need to produce 26,000. Okay. Then what is the required production for May? I'm gonna let you look at that. What do you think? $52,000. So the 46 is a result of, again, the desired inventory is going to be 20% of June. So we've got 56, but we're going into the period with 10,000. So we need to produce 46. Got it? Then in June, we need to have the desired ending inventory. July sales are, they tell us already, are going to be 25,000. So we need 5,000 here, but we started with 6,000. Okay. Exercise 8.2. Down Under Products of Australia has budgeted sales of its popular boomerang for the next 4 months as shown. The company is now in the process of preparing a production budget for the second quarter. Past experience has shown that end of month inventory levels must equal 10% of the following month's unit sales. The inventory at the end of March was 5,000 units. Using Schedule 2, prepare a production budget by month and in total for the second quarter. Okay. So what we're going to do is we show the budgeted sales. We have our desired ending inventory, which they say is going to be 10% of the month's, the future month's sales. And our ending inventory here, which is again going to be the beginning inventory is going to be 10% of that future month's sales. So just like in what we looked at earlier, we can figure out the required production units we need to manufacture in this format. We have to budget what the estimated sales are going to be. We have to know what they want in ending inventory for the future month. Okay. Next, after we do that budget, the production, then we need to come up with a direct materials budget. You got to do the production budget before you know what you need to get. At Royal Company, 5 pounds of material are required per unit of product. Management wants materials on hand at the end of each month equal to 10% of the following month's production. On March 31st, 13,000 pounds of material are on hand. Material cost is 40 cents per pound. So we know 10% needs to be an ending inventory for the next budget. Okay. So here we've got from the production budget what we need to produce for each month. We know we need 5 pounds per unit. So we've got our needs. We also know we need to have 10% on hand at the end for next month's budget. And they gave us the March 31st ending inventory, which was 10% of the next month's. So this then shows us how much of these this product materials we need to purchase for the month. So here they gave this to us. So for May, how much materials need to be purchased in May? Again, we're going to need to have 14,500 dollars of desired ending inventory. The 230 plus the 14,500 gives us what we need. Then we take away from that our beginning inventory, which would be the 23,000 to show what needs to be purchased. So how many materials need to be purchased in May? It's like 230. Oh, I was off. 221. So you take the 230, add the 14,500, subtract the 23, which gives us the materials in May that need to be purchased. Okay. Do the same thing for June. And to come up with the total for the quarter, what they're showing is you're taking April. So coming into this quarter, we had 13,000 of beginning inventory. The ending inventory will be at the end of June, the 11,500. Okay. All they're doing is doing it for the whole 3 months. Now that we've done the materials budget, now we need to figure out how much cash we need. Royal pays 40 cents per pound for its materials. 1/2 of a month's purchases is paid in the month of purchase. The other half is paid in the following month. The March 31st accounts payable is $12,000. So to calculate the disbursements here, we're going to take what we purchase, what we need to purchase in April gets paid, a portion in April and a portion in May. what are the total cash disbursements for the quarter? Again, we're going to keep doing this each step of the way. So basically, we've got our April purchases are going to, the payment will be half in April, half in May. The May purchases, half in May, half in June. The June purchases, half in June, half in July. So if we add all this up, we need cash of $185,000 for the quarter. Okay. So now we've got our exercise 8.3. 3 grams of musk oil are required for each bottle of mink caress, a very popular perfume made by a small company in Western Siberia. Ooh, this isn't a good one with all the stuff going on with Russia. Huh? Giving you a hard time. You know what's sad about it is we're all the same with people. It's just these dumb governments. I'm sure the Russians are hurting so bad, which is really sad. Just those in power. The cost of the musk oil is $1.50 per gram. Budgeted production of mink caress is given below by quarters for year 2 and the first quarter of year 3. The inventory of musk oil at the end of a quarter must be equal to 20% of the following quarter's production needs. Some 36,000 grams of musk oil will be on hand to start the first quarter of year 2. Using Schedule 3 as your guide, prepare a direct materials budget for musk oil by quarter and in total for year 2. So just like we did previously, 3 grams are needed. So we come up with the raw materials. We know what our ending inventory needs to be based on the next month. We come up with our amounts needed at $1.50 a gram, gives us what we need in cash for the raw materials to be purchased. Okay. Now that our raw material budget has been satisfied, we need to come up with the direct labor budget. Each unit of product requires 0.05 hours, 3 minutes of direct labor. The labor can be unskilled because the production process is relatively simple. Royal pays its workers $10 per hour. So if they're really efficient, they could do 20 of these in an hour, right? So from the production budget, we know how many items. We know we need 3 minutes per item. So it tells us how many labor hours are required each month. If you figure out $10 per labor hour, it gives us the cost we need for direct labor. Easy. Now, the manufacturing overhead budget. So manufacturing is applied to units of product on the basis of direct labor hours. The variable manufacturing overhead rate is $20 per direct labor hour. The fixed manufacturing is $50,000 a month, which includes $20,000 of non-cash costs, depreciation. So in order to prepare this budget, we know our budgeted direct labor hours. We know based on that Our manufacturing overhead rate is $20 based on the direct labor hours. We know our fixed costs and manufacturing fixed costs. So they break this down by total manufacturing costs to be $49.70 per hour. So they're basically taking the 5,050 direct labor hours, 251 divided by that number of labor hours to get us the $49.70 per labor hour. Okay. Now, since depreciation doesn't need cash per se, the asset's already been purchased. Excuse me. We can subtract for cash disbursement purposes. We can subtract out that amount because that asset has already been cared for. It's just a non-cash expense. Then our finished goods inventory budget, we see the 5 pounds at the cost, giving us the total cost of the finished goods. Again, with direct labor, we know 3 minutes a product times $10 an hour gives us our cost per unit. Manufacturing overhead is going to be based on direct labor hours, 3 minutes at $49.70 an hour. So this gives us our cost per unit. Okay. So basically, if we end with 5,000 units at a cost of $4.99, this is the cost of our ending inventory. Okay. Okay. Let's look now at exercise 8.5. The direct labor budget of Well Corporation for the upcoming fiscal year contains the following details concerning budgeted direct labor hours. The company uses direct labor hours as its overhead allocation base. The variable portion of its predetermined manufacturing overhead rate is $3.25 per direct labor hour, and its total fixed manufacturing overhead is $48,000 per quarter. The only non-cash item included in fixed manufacturing overhead is depreciation, which is $16,000 per quarter. Using Schedule 5, prepare the company's manufacturing overhead budget for the upcoming fiscal year. Compute the company's predetermined overhead rate, including both variable and fixed, for the upcoming fiscal year. So it gives us our budgeted direct labor hours. So here we take them by the manufacturing variable overhead rate, add the fixed, gives us our total manufacturing overhead, less our non-cash, gives us how much we need in cash for manufacturing overhead. Compute the company's predetermined overhead rate. We take the whole amount for the year, $297,625, divide that by the labor hours to give us our overhead rate for the year. Then, if that wasn't enough, we now have our selling and administrative budget. So it gets divided into variable and fixed components. So we've got here the variable expenses are 50 cents per unit and the fixed are 70,000 a month. 10,000 is non-cash. Okay. So in order to prepare the selling and admin, we take budgeted sales, the variable selling and admin rate, add our fixed costs to have our total costs, subtract out the non-cash to see what we need in cash disbursements to cover our selling and admin for each month. Okay. And what would it be for the quarter? Well, again, you just carry this all the way through. Excel's wonderful with this, isn't it, guys? You just plug in a couple numbers and poof. Again, this is Schedule 7. Gives us the different information showing us the variable selling and admin is at 250, and then it gives us our fixed, and it shows us our depreciation, and then this gets a little more, it tells us specific amounts. So it tells us the executive salaries per quarter. The insurance payment is going to go out in the first quarter and the third quarter, and property taxes happen in the second. So it's just adding in some pieces we just are going to adjust to fine tune it. As you see here, the insurance happens in 2 quarters. The property tax happen in the second quarter. So this just more aptly identifies the cash needs each quarter and for the year. Then we're going to figure out the cash budget. So we already kind of know, we know roughly where our receipts are going to stand based on the number of units we're selling each quarter. We know our disbursements based on going through that whole process. And then because of that, we may need to get monies from sources during the periods when the money is lean. Okay, so they keep all this information open, letting you know the line of credit available, letting you know what they desire their minimum balances to be. Again, letting us know when they repay loans, when they borrow money. The dividends are also a part of the cash budget. What equipment purchases are going to happen, and what we're starting the budget with. Okay, so we're starting the budget with 40,000. We know what our cash collections are going to be from our budgeted sales. Okay, so which gives us our total cash that's going to be available. We know what our disbursements are going to be from our various budgets we've already created with materials, direct labor, manufacturing overhead, and salaries. Now they gave us some additional information knowing our dividends are going to go out here in April. So it tells us we're going to be in the hole 18,000 for April. So we're going to need to borrow something because they want a minimum of 30,000, remember, in their account. So we're going to need to borrow 48,000 for the month of April, right? That's what we're going to need to borrow. So then in May, we look and see, oh, we've got an excess here of 48,000. after we're all said and done in May. So moving on, in May, we've got that excess 40,000, but we didn't pay anything back on our borrowing yet. In June, you see that we've got an excess of 130,000 in June. So we can pay back our borrowing, calculate the interest on that money we borrowed to see what our ending cash balance is going to be. Does that make sense? So now that we've done all that, we can come up with our income statement. Garden Depot is a retailer that's preparing its budget for the upcoming fiscal year. Management, oops, did I do that? Management has prepared the following summary of its budgeted cash flow. The company's beginning cash balance for the upcoming fiscal year will be 20,000. The company requires a minimum cash balance of 10,000 and may borrow any amount needed from a local bank at a quarterly interest rate of 3%. Now they're telling us it's a quarterly interest rate. Okay, not annual, quarterly. Annual would be 12%. Just be aware of those little things. The company may borrow any amount at the beginning of any quarter and may repay its loans or any part of its loans at the end of any quarter. Interest payments are due on any principal at the time it is repaid. Assume interest is not compounded. Using Schedule 8, prepare the company's cash budget for the upcoming fiscal year. Again, we've got the beginning balance, estimating our receipts, less our disbursements, the borrowings, and our ending cash balance each time. So in the second quarter, we paid back what we borrowed in the first quarter along with the interest. Okay. So to prepare a budgeted income statement, everything's taken from those individual budgets. The sales budget starts. Then we have our materials, our labor, our manufacturing overhead budget. We have our selling and administrative budget. And the cash budget helps us understand what kind of interest expense we're going to incur for the period. Okay. So Gig Harbor Boating is the wholesale distributor. Oh, I spelled that wrong. Sorry. Of a small recreational catamaran sailboat. Management has prepared the following summary data to use in its annual budgeting process. We've got our selling price per unit, the cost, the variable, administrative, and selling, the fixed, and the interest. We'll prepare the most important number of unit sales there. There it is. So we've got our sales, our cost of goods sold, which gives us our gross margin, our selling and administrative. We had some variable and some fixed, gives us our net operating income minus the interest expense, provides us with our net income. Okay. Okay. Now, this is the last one, the budgeted balance sheet. Excuse me 1 second here. Okay. Royal reported the following account balances prior to preparing its budgeted financial statements. Land, common stock, the April 1st retained earnings, and the equipment. Then for June, we show 30% of June's sales of 300,000 will be in our accounts receivable. We show the raw materials inventory, the finished goods inventory. We know our equipment. We know what we had as payables during the period. And the retained earnings is going to be a result of the beginning balance plus our net income minus the dividends we paid out. Okay. And here, if we've got our accounts receivable, our inventory, supplies, equipment, accumulated depreciation, accounts payable, and common stock. And it tells us with Mecca copy, the beginning balance of retained earnings was 28,000. Net income is budgeted to be 11,500, and dividends are budgeted to be 4,800. So we can come up with our retained earnings by the 28 plus 11,500 minus the 48,000 gives us, let's see, what would that be? 23,2.
34,700.
Thank you, 34,700. Okay, so we know what our retained earnings is, the 34,700. All these other figures were given to us, so we know our total liabilities and stockholders' equity. Since we know our assets need to be the same as our liabilities and stockholders' equity, we can plug in for cash, can't we? Make sense? Wheeling is a merchandiser that provided a balance sheet as of September 30th, as shown below. So we've got all our assets, our liabilities, and our stockholders' equity. The company is in the process of preparing a budget for October and has assembled the following data. Sales are budgeted at 240,000 for October and 250,000 for November. Of these sales, 35% will be used for cash. The remainder will be credit sales. 40% of a month's credit sales are collected in the month the sales are made, and the remaining 60% is collected in the following month. All of the September 30th accounts receivable will be collected in October. The budgeted cost of goods sold is always 45% of sales. And the ending merchandise inventory is always 30% of the following month's cost of goods sold. All merchandise purchases are made on account. 30% of all purchases are paid for in the month of purchase. and 70% are paid for in the following month. All of the September 30th accounts payable to suppliers will be paid during October. Selling and admin expenses for October are budgeted at $78 exclusive of depreciation. These expenses will be paid in cash, and it tells us the depreciation is budgeted at $2,000 for each month. Using this information, prepare the budgeted cash collections for October, the budgeted merchandise purchases for October, the budgeted cash disbursements for merchandise purchases in October, the budgeted net operating income for October, and a budgeted balance sheet. Let's just do that, okay? So, oh, did I not finish this? Okay, let's get on here. I didn't show this, so let's go and look at this. One sec. Exercise 817. I'm not going to end it there. Of course, we got to figure this one out, right? 10. Okay, I must have. That's not it. There I am. And I just want to confirm 817. That's weird. What did I just do? Sorry, guys. Okay. So the budgeted cash, I wish I had a couple screens up here so I could give us the information they gave us, but 240,000 at that 35% gives us our cash sales. Our September credit sales that were collected in October's 90. The October credit sales collected in October would be the 240,000 times 65%, 40% of that, 62, which would give us our total cash collections. Then to come up with the budgeted merchandising purchases, the cost of goods sold, 240,000 at 45%. Then we add our ending inventory, the 33,750. We subtract our beginning inventory, so we know what our required purchases need to be. Cash disbursements for the merchandise purchases. This is October. The September credit purchases we got to pay in October, and the October credit purchases we're going to pay in October. gives us our disbursements here. So our net operating income, sales, the cost of goods sold. They gave us the information regarding selling and admin to give us what our net operating income is. Budgeted balance sheet is shown here. Budgeted balance sheet shown here, and budgeted cash collections of $252 for October. Then merchandising purchases. Again, it's unfortunate I don't have the others up because really there's so much detail in here to go back and see what their requirements were. Budgeted cash disbursements. Oh, this was the different assumptions I didn't even go into yet. So I think we can just leave it at that. And then these were the changes here. Let me go back to this PowerPoint. They had some different assumptions for number 2. And I don't think we even need to get into that. Just, this is plenty. Okay. Any questions? It's pretty simplistic, but there's just a lot. Okay. So are you interested in seeing your homework? Would you like that? Okie doke. Homework. Let me go back here. We've got for chapter 8. Again, very similar to what we're doing here in class. Here is requirement 1. Okay. Requirement 2. Three. Or 2B, I should say, and then here's 3.
Go back.
Go back one.
Yeah.
Next. Number 2. Cash collections. Merchandise. Cash budget. Income statement. Balance sheet. Next. Cash collections. Purchases budget. Cash disbursements. Cash budget. income statement, balance sheet. You guys good? All is well? Well, guys, that covers it for this chapter.